Today, we shall discuss the importance and the limitations of the selective credit control measures. They are also called the qualitative credit control measures. Let's begin. See, the selective credit control measures, what they do is they divert the credit from the non-essential, less urgent areas to essential and more urgent areas. What does this mean? Now see, the commercial banks, they keep on lending loans and advances, right? To anybody who comes over, they have their own terms and conditions. You may have to keep a collateral. You have to show your proper profile, your case, and then obviously you will be granted a loan. You want to start a business opportunity, you want to start a new venture, that's up to you. Now, this diversion of credit to certain areas and withdrawing the credit from certain areas, this is done with the help of these selective credit control measures. The government specifies with the help of this monetary policy that at the present moment, India, the country, needs to prosper in these very segments. Okay, maybe the RBI policy decides that we have to promote the pharmaceutical sector. Okay, so what will be done with the help of these selective credit control measures? More and more loans will be given to persons who come to enter the pharmaceutical industry. Maybe the government decides that we are supposed to promote the education sector. The same will happen with the education sector. You come over to open a university or an educational institution, you will be granted easy loans with less rate of interest or with more subsidy, such type of things, right? Maybe in these particular sectors which the government thinks are more important, you may be allowed loans with lesser collateral. Okay, whereas if you ask loan for the other segments which are not urgent, there you may be asked more collateral, or there the terms and conditions would be tough and difficult for you. Okay, so the loans are made easily available in those sectors where RBI wants to push the economy in that direction. So basically, if the RBI wants to divert the credit, let the country flow in the hands of this particular segment industry, so will it happen. And how does this happen? This happens by the help of these selective credit control measures. Now, it could be quite possible that you may approach commercial banks, or any XYZ person can approach commercial banks for certain unproductive areas, certain speculative segments, okay, for example, betting and all, and then you will be denied that credit. Why? Because RBI doesn't want to promote people into such activities. So the choice lies in the hands of the monetary policy framed by RBI, that the money will be diverted towards which all sectors, which all areas. Okay, now further, these measures influence only the particular targeted areas of the economy. They don't affect the economy as a whole. Now listen, how much credit has to be given to the people? How much money is to be shown in the hands of the people? This is not the domain of the selective credit control measures. The quantitative measures deal with this area. Here, when we are talking about the selective credit control measures, they are just concerned with, their agenda is just that particular area which they want to target. Now, supposingly the government says that we have to promote the hotel industry in our country. So what will happen? With the help of these selective credit control measures, hotel industry will be given enough loans. The terms and conditions for availing loans in this particular segment will become easy. People will be encouraged to take loans and enter into the hotel industry. So this is what is happening with the help of selective credit control measures. Now, what is going to happen in other areas? They don't give a damn to that point. And how much credit? This is also not our agenda. This is also not influenced by the selective control measures. They just particular targeted areas of the economy. Clear? Now, these measures discourage excessive consumer spending on the durable items which are financed by the hire purchase. Now, regulation of consumer credit is a very important tool which comes under selective credit control measures. Now, what happens is, when you take a durable item, be it a car, be it a washing machine or a microwave, if you take it on hire purchase, what happens is you will have to pay a little earnest money, lump sum payment at the beginning, and the rest of the amount you will pay in installments with interest. Okay. Now, if the RBI or the monetary policy holds the view that this particular durable item should be there in every house, so what will happen? You will be given loan or you will be allowed hire purchase installments at a lesser rate of interest, because RBI wants to encourage people to buy that particular durable good. Okay. And at the same time, if the central bank thinks that this particular durable good, there's excessive in every house and which is also not of very important use, so it will be given tough terms and conditions. Higher purchase installments will be given with a higher rate of interest. You will be asked for a higher lump sum payment. Automatically, people will be discouraged to go in for the higher purchase of that particular item. Okay, if RBI thinks that people are spending a lot on these items, so much spending is being done on these luxury items, people are just gone mad on these comforts. Instead, the promotion of necessities should be done. So all these luxury items, they will be discouraged to lend on hire purchase. The terms and conditions only will be so tough that the normal person, he will be discouraged to buy all this. So how does this happen? How does RBI tend to influence people or discourage people to buy that particular product? This all happens by the selective credit control measures. Okay, now listen, selective credit controls are very important, particularly in the developing countries. Why so? Because quantitative methods are not effective as there is underdeveloped money market. Now, quantitative methods are also important. They are very significant. But the point says that in the developing countries, there is underdeveloped money market. People are not highly literate to use that. So that is why, because there is not flourishing money market. Therefore, here comes into effect in the developing countries these selective credit control measures. So even if the money market is there or not, these measures tend to influence the credit policy of the central bank. Now, as I would like to mention that selective credit control measures include the margin requirements, the regulation of consumer credit, the rationing of credit, moral suasion, then there is direct action undertaken by the central bank, and of course the publicity which is done by the RBI. I have made a separate article and a video on this selective credit control measures. Kindly go through them, learn them nicely, then come back to this article to understand it nicely. Now, by these selective credit control measures, central bank exercises its priority sector lending. Now, the central bank will definitely classify these sectors into priority and unpriority ones. The priority sectors, people will be encouraged to come over and spend in these priority sectors. For that sake, the loan facility provided by the commercial banks will be at ease in these priority sectors. Preferential treatment to the backward sectors. Now, supposingly that the government feels that the rural artisans or this khadi manufacturing or the cotton cloth manufacturing has taken a back seat in the recent years. So in that case, this will become the priority sector of the RBI, and you can easily get loans for that. So this is how the funds will flow in this sector where RBI wants it to flow in. The magic wand lies with the Reserve Bank of India. It will classify the priority and the non-priority sectors, and with the help of our topic today, the selective credit control measures, the credit will flow in these priority sectors. It can be quite possible that at times agricultural sector comes in the priority list of the RBI. Maybe it wants to pay more attention to the small scale sector, to the education, to the pharmaceutical sector. It can be the hotel industry. Anyways, so that RBI decides through a well-planned monetary policy, and selective credit control measures help the central bank to attain the aim of injecting credit to these priority important sectors. Now, these measures, they help in ensuring balanced economic growth. every sector will be paid due attention, and then a weightage of every sector is different according to RBI. Now, how much weightage has to be given to X sector, it will be different from how much has to be given to the Y sector. So how will you exercise it? It is this credit control measures only which help the central bank to fulfill its aim of credit control. These measures remove imbalances which crop up in an economy in the process of economic development. It can be quite possible that the giant business houses, right, they are taking a larger share, larger chunk of the institutional credit to themselves. And normal citizens like you and me, they are deprived of the credit. Even if our portfolio, our profile is good enough to enter into a bigger startup, it is a profitable startup which has its future, but still, because the larger chunk of that credit is taken away by the big business already established giants, so we'll end up nowhere, right? So here comes the selective credit control measures. They try to maintain the balance in the economy, taking importance, giving weightage to every person who comes to this commercial bank to avail the credit facility, right? Now, they also help to curb the inflationary tendencies in the developing countries. So these qualitative credit control measures, they also help to curb inflation, right? How does this happen? Now, if the RBI thinks that there is a lot of money in the hands of the people which they are spending unexcessively, ruthlessly, the expenditure is being taken place on the luxuries and the comforts, and inflation has taken all-time high. So what they will do is they will increase the rate of interest at which the commercial banks will offer the loans to the general public. Once the rate of interest is set very high, people will not go to the commercial banks to take loans. So the injection of credit which the commercial bank has been doing in the hands of the people, it will come down because the rate of interest is so high. People will be discouraged to take loans, right? So the inflow of funds will be limited, it will be restricted. So this is the way this central bank helps to curb inflation. Okay, because money will not be injected in the hands of the people. Inflation will automatically be combated, it will be controlled. Now, these selective credit control measures, they also encourage productive investments and restrict unproductive investments. How does this happen? Maybe you also go to avail a loan, I also go to avail a loan, and it can be possible that yours is a productive investment where you want and mine is unproductive investment. So what will the commercial bank do? Commercial bank will say no to me and say yes to you. So what happened? Actually, productive investment was encouraged to take the loan and start the venture, and a person like me who was going for unproductive investment, it was banned. It was asked not to do so. So the money of the country was safe in the hands of productive investments. So this is the importance of what? The selective credit control measures. It helps the commercial banks to understand what is more productive, what is more urgent, the priority sector which has been set by the RBI. So this is how the things work. Now further. Now there are certain limitations also of these selective credit controls. They are effective in influencing the credit policies of the commercial banks as laid by the RBI, but they fail to affect the non-banking financial institutions. Other than the commercial banks, there are a lot of financial institutions who are ready to provide loans to the public. They may not go by the rules set by the RBI. So what is happening? They are not going by the monetary policy. So they may be charging a little higher rate of interest. They are so commercial that they give a damn to the venture for which, the purpose for which the loan is being put to. They are okay with it. They charge high rate of interest and they give you money. Okay, this is your money, you can do whatever, but you give me interest at this much interest at this point of time. So these non-banking institutions, they cater to a larger chunk of total credit which is not under the central bank. So they don't comply by the rules of the central bank, by the rules of the monetary policy, and they don't go by these rules, and it's a hindrance to achieve the credit control as wished by the RBI. Now, the central bank tries to divert the funds from unproductive segments to the productive areas, just as I discussed to you in the previous slide. It is always the it is always the try of the commercial banks. They always try to put the money into productive areas, into and to refrain to put money from speculative areas. They discourage people to do that. But the fact is that commercial banks find it hard to distinguish between these two activities. So there is a very narrow slippery line to what is productive and what is unproductive. Now, whosoever goes to take the loan, according to that person, though I am very productive. My venture is the most productive one. It will be most profitable. I will be providing employment also. I will be abiding by the rules also. But then how to make out that which one is productive and which one is non-productive area? Okay, maybe sometimes people misuse the funds. So the commercial banks find it very difficult, and at times the funds, they go into unproductive segments as well. Now the commercial banks, no doubt, they give loans for the productive purposes, but what will happen if the borrowers use it for unproductive purpose? Now my loan gets sanctioned, I come back very happily. Maybe I don't put the money into use for which I was supposed to put it. Maybe I use it for something else. So these points, they are beyond the reach of commercial banks, and it actually at times happens. Now, the selective credit controls, they are barely of any use in the indigenous and unorganized banking sector of the developing economies. No doubt, things have changed. As for India also, things have changed. RBI has done enough publicity to educate people to come over to the commercial banks only for the proper loans and for the proper rate of interest also, so that other people may not be charging exorbitant rate of interest. But still, in the rural areas, in the backward areas, there are certain indigenous bankers, there is unorganized banking sector. People fall prey to these money lenders as well, and here the selective credit control measures, automatically they are of no use. Now the commercial banks, sometimes with the greed of higher profits, just to make more and more profits, they manipulate their accounts and therefore advance loans for the prohibited uses as well. You may have listened a lot about it in the news. Sometimes the banks, they advance loans for the unproductive or the speculation activities as well. And at times, the commercial banks, they also want to show their higher profits, and for that they may come influence of their profit, and they may be advancing loans for the prohibited uses as well. And here again, the selective credit control measures fail, right? Now further, so the conclusion comes that no doubt selective credit control measures are very effective tools in the hands of central bank to achieve the desired monetary policy. But for a successful monetary policy, both qualitative measures and quantitative measures, they should be used judicially, hand in hand. I would like to mention that I have made a separate video for quantitative measures and a separate video for qualitative measures in full detail. Kindly go through them. These measures, they are not competitive to each other. They are not their substitutes, no, but they are supplementary. They should be used judicially with the wise thinking of the Reserve Bank of India to achieve the desired monetary policy and to influence the credit system in the economy. So here we come to the end of the article. I hope I have made the things clear to you. In case you have any doubts regarding any of these topics, feel free to ask me in the comment section. Please subscribe to my channel. Thank you for watching. Stay safe, stay blessed.